Hello and welcome to a new Cryptomatic's episode. Today, I will explain what margin trading means, how it works, and analyze some key elements associated with it, such as long and short positions or margin funding. What is margin trading? Margin trading refers to using borrowed capital from a broker in order to make an investment, such as investing in crypto. Now, it is more popular than ever since, unlike regular trading, margin trading lets you have access to a large sum of money and leverage your position. Basically, margin trading offers you the chance of achieving larger profits from successful trades. At the same time, though, the potential for loss is also higher. How does margin trading work? To put it as simply as possible, a trader has to offer an initial deposit in order to open a position. This is known as an initial margin. The trader needs to have an account holding a particular amount of capital in order to keep this position. When working with crypto exchanges, the amount of capital deposited is used as collateral by the exchange platform. When it comes to margin trading, the amount that an investor can use for leveraging is determined by the platform used for trading and by the initial deposit made. Leveraging offers you more buying power as it lets you explore larger positions compared to using only the money you have in your account. Leverage is normally described as a ratio like 1 to 10 or 1 to 30. Let's say someone puts down $25 and leverages 4 to 1 in order to borrow $75 and buy $100 worth of Bitcoin. There will be only one stipulation. Regardless of anything, this investor will have to pay back $75 plus fees. In order to make sure that it will get its loan back, the exchange will call in the trader's margin trade once it reaches a price where the trader might actually start losing the money he or she borrowed, since the exchange borrows money for trading, but it doesn't want its users to lose the money. What are long and short positions? We've mentioned open positions, but what are they really? Usually, in crypto margin trading, you can benefit from two options: going short or going long. In the case of long positions, the trader will anticipate the increase in price of a crypto asset, which means they will register profit based on how much the price has increased. Short positions represent the opposite, in which the trader anticipates the decrease of the price of a crypto asset. Short positions are generally used by traders who want to register profits from failing cryptos. Margin trading presents a risk as a result of leverage. As you increase the leverage amount, traders have the possibility of trading more than what they really own, so you can enjoy more profit but also deal with more loss. What is margin funding? If you think that margin trading is too risky for you, there is a second option that involves making a profit from the leverage trading methods called margin funding. In margin funding, you are allowed to commit your money to fund the margin trades of other users. In the case that a trader accepts the terms presented and agrees to the offer, the provider of the funds can receive repayment of the loan using the agreed upon interest. The actual mechanism may vary from exchange to exchange, but that is the main idea, and it is one that some find appealing as it is considered less risky than margin trading. Conclusions. Margin trading can help you explore more of the world of crypto as it lets you open bigger positions. At the same time, if you lack the needed experience, it can become quite a risky endeavor as a result of several factors, including the notorious crypto volatility. I hope you enjoyed today's video, and if you have other questions about margin trading, don't hesitate to tell us in the comment section. So much for today. Don't forget to subscribe to the Cryptomatic's channel if you want to stay up to date with the latest concepts in the crypto sector.